Whether you're a seasoned investor or a first time, ETFs or exchange traded funds are a great way to really grow your wealth and diversify your portfolio. With thousands of ETFs to choose from, how exactly do you determine which ones that are going to be worth considering? Today's video, we're going to be looking at 4 Invesco ETFs that could help you retire a millionaire. Overall, personally, I am not super familiar with some of the Invesco ETFs. Some of them I do hold in my portfolio, but I wanted to look at the ones that they chose in this list today on MSN.com. First one they look at is the Invesco S&P Mid Cap Quality ETF. Now we know one of the best investors of all time, Warren Buffett, has always said to focus on the quality of the companies that you're investing in. Now this is a mid-cap quality, which means it is between $2 and $10 billion. So if the companies are bigger than $10 billion, they are not going to fall into the mid-cap category. This ticker symbol is XMHQ, which is very important to look at, and I will put them up on the screen so you can check them out. Now, the difference between this, when you think of the larger companies and the big tech stocks, when you think of Google, Nvidia, when you look at Microsoft, they are massive, massive tech companies. This has a lot of diversification, 18% in manufacturing, 16% in finance, 8% industrials, and 8% technology are the largest sectors that we do have here. So again, when you start looking at some of the S&P funds where, 20, 30, even 40% might be based on those technology companies, which are just really the trillion-dollar companies, this focuses on that middle ground within there. Now, of course, the 5 biggest holdings that they have are Manhattan Associates, Williams-Sonoma, Reliance, Carl Island Company, and MCOR Group. The quality in the fund comes from the methodology that Invesco is using. And again, as much as I'm educating you guys, definitely an education for myself as well. It examines the S&P Mid-Cap 400 Index, and based on fundamentals such as high return on equity, balance sheet strength, and overall market cap, that is how they are selected for this specific fund. Has a very low expense ratio at a 0.25, which means $25 on every $10,000 that is invested. So again, just like regular ETFs, it is a very, very low price. Which I like with the fund expense ratio. Have to make sure you keep those expenses low. And of course, if you like the ETFs as much as I do, please consider subscribing to the channel. Give it a thumbs up and let me know some comments down in the bottom. Looking at number 2, and this is a new one for me that I have not seen, the Invesco NASDAQ Internet ETF. That's right. This is a sector-specific ETF that fund and really targets companies whose primary business is operating through the internet. Now, again, this can be some of the world's best known companies, and it does include some of those tech companies. Looking at the list of the holdings, Alphabet, Amazon, Meta, Microsoft, Apple, Walt Disney, Bookings Holding, Netflix, Salesforce, Uber. So that's right. This is a massive, massive technology stock, and of course, or technology ETF. And of course, some of these are really big chunks. Alphabet 9.3%, Amazon 8.2%, Meta 8.2%, Microsoft 8%. So right there, I mean, you're comprising almost 40% of the portfolio. Apple adds 7%, Walt Disney, Booking Holdings another 4+. Right there, we're already up to 50, almost 60% of what we're carrying in here. Now, this is very risky in my opinion. When I start looking at ETFs, in the sector ETFs specifically, only focus on one sector, which of course, if they're doing incredibly well, it is going to be up through the roof like we see with our growth sector. But if it is underperforming because you are tied and your risk mitigation and you're only investing into one specific sector, if the sector itself, like the technology sector, does take a little bit of a downturn, you are going to see a bigger downturn with this one. Now, of course, when you look at the return, this is where it kind of comes in. When you look at the S&P 500, it yields about 10 to 11%. This one specifically, again, because of AI technology, everything else is running about a 14.02% return over the last 10 years, which is kind of crazy. So, I mean, you're talking almost, over a 3% higher return with a very low expense ratio of a 0.6, which again is kind of interesting to see how they built this out. Next one we look at is the Invesco S&P 500 Quality ETF. So again, Invesco coming in with the quality investing. This is really different than we see with our traditional S&P 500 like the VOO. This one, the ticker symbol is SPHQ. And of course, with this one, what it does is it takes the S&P 500 index and really fine tunes the weight and what is going to go in here based on, again, the performance of what they consider quality at Invesco and what's coming in here. It is not the same as the S&P 500 because, again, depending on the company, it could differ. Now, this, very similar to the list we just seen, we have Microsoft, Apple, Nvidia, Alphabet, Amazon, Meta, Berkshire Hathaway, Eli Lilly, Broadcom, and JP Morgan are the top 10 holdings in here, but they have a very, very small stake. When you start looking at Microsoft at 7, we have Apple at 5.8, Nvidia at 4.8, Apple at 4, and then it goes 3 and kind of goes down by there, which is really good because then you're not holding as much in a specific company. So again, when you're looking kind of at the breakout of this, the weightings are incredibly different than what we normally see with an S&P fund. Now, expense ratio on this one, 0.15 expense ratio means $15 for every 10,000 that is invested. Now, of course, lastly, it boasts a dividend yield of 1.3%, which is exactly in line with the S&P 500. But again, you have to look at what you're weighted for in different sectors and what exactly that they're investing in. Now, next one is one that I personally hold, which is the Invesco QQQM Trust. That is right. The ticker symbol is QQQM. This is one of the really, really prominent Invesco funds. If you've seen the commercials and the technology, the known as the Qs is what they call, is one of the largest ETFs in the world, which only this is second trading volume to the SPDR, the SPY, or the S&P 500 trust fund that SPDR has. So this is number 2 when it comes to the daily trading volume, which is kind of crazy. Now, of course, when you look at the return, the 10-year total return is 18.4%. Yes, let me say that one more time. The 10-year return on this one is 18.4%, which is kind of incredible. Now, of course, very, very, very tech heavy. Looking at the tech giants, Apple, Microsoft, Nvidia, Broadcom, Alphabet, Meta, all of those very cheap and easy way through this to invest in the big tech companies. Fund ratio of a 0.2%. Which again is very, very low when you kind of look in comparison. The QQQM is a little bit cheaper on the funds expense ratio side, but overall, again, it is one that I hold specifically, which means that it could be a really good buy for you as well. Now, if you checked out my 3 dividend portfolio, this is actually one that I included in there as well. But looking at 4 Invesco ETFs that could help you retire a millionaire. And again, thinking of this fundamentally or really big picture, is if you look at it, you have a mid cap, which is pretty good. And of course, it is a quality mid cap, meaning that you're not going to be invested in all of those large cap S&P 500 companies. So a lot of diversification within that itself. Then you start getting heavy into the tech. Now, of course, looking at that mid cap, you could almost consider it kind of a foundational ETF like what we talk about. But looking at the NASDAQ Internet ETF, this is going to be your superstar, your super high growth rate. And of course, comes with a very, very high risk on that one. The NASDAQ on this one, or the ticker symbol, is PNQI. Then you start getting into kind of the Invesco S&P 500 quality ETF. Again, so if you're holding the S&P 500 quality, if you're holding the mid-cap quality, they are entirely different markets with different investments, meaning there's going to be little to no overlap in there, meaning that if you put, let's say, 25% in this Invesco S&P quality, and then you put, 25% of your portfolio into essentially putting it into the mid-cap quality, you'd have a really good diversified kind of portfolio. And then, of course, you could go in for the very specific sector, which, of course, is that internet sector, which I would not do personally. From there, I would probably either put in 25% or 50% into that Invesco QQQM, just making sure, again, that you have the very heavy tech holding. Now, of course, this is going to vary greatly depending on you, depending on where you're at. So what I do is when you think about 50% being into a growth ETF, it is pretty heavily weighted, but we're talking probably the 20 to 40, 20 to 50 age range. Once you start getting into, the 50 age range, I would do a little bit more of the mitigation, probably cut back on some of that growth factor, because at that point, you've had essentially 30 years of growth within there, really strong build portfolio. Even taking it from like a 50% with that big growth, the VUG or the QQQM, and really toning it back a little bit. And what I'm doing personally, my plan is when we get to that point, is starting to move a little bit more into like the SH or the SCHD, moving a little bit more in the VYM, essentially getting 30 years of growth out of a really solid portfolio. putting a couple percentage into the dividend yield, which is going to supplement essentially Social Security or supplement the income upon retirement. That way we have a regular income without having to touch the principal, because we spent a multitude of years growing the balances of these really big ETF funds. And now it's time to slowly take those dividends out. But hoping at that point, if you have $1 million, $1.5 million, $2 million into retirement accounts, even putting $500,000 into something like the SCHD, you are going to have a very, very massive dividend income that you're going to be getting out of there. Of course, you do have to pay taxes on it, but overall, paying some tax while still having a regular income coming in is what we're looking for with some of the diversification, and still letting the rest of the portfolio really grow to a sizable amount and continue to grow even when we're in early retirement. And as we continue through retirement, again, supplementing it with multiple passive income streams is exactly what we're looking for. So, all right, guys, so that is going to do it for today's video. The 4 Invesco ETFs that could help you retire a millionaire. Let me know in the comments what you guys think. And as always, thank you guys for watching.